I want you to stop whatever you are doing right now, because the window we have been waiting for, the opportunity that people will look back on with profound regret if they missed it, is closing rapidly. This isn't just another cyclical market prediction based on technical analysis or fleeting sentiment. This is perhaps the most serious, most deeply researched, and potentially the final warning you will receive before the event horizon shifts completely and irrevocably. We are standing directly on the precipice of a monumental breakout, and I am talking specifically and exclusively about the physical silver market. When an industry titan like Eric Sprott, a man who has navigated bull and bear markets, who understands the physical flows of metal better than almost anyone alive, who controls significant tangible inventories, and who has made his fortune based on correctly timing structural shortages, when he uses terms like final warning, you don't dismiss it. You analyze it. You internalize the gravity of the statement. His message is not merely cautionary, it is stark, rooted in irrefutable logistics. The foundational mechanics of the silver market are reaching a catastrophic tipping point that favors only the prepared. The systemic imbalance between paper promises and physical reality, which we have discussed in detail for years, is now visibly buckling under its own weight, threatening to collapse the entire pricing structure built upon decades of financial engineering and suppressive trading. Look around the macroeconomic environment today. Inflation isn't transitory. It is entrenched, deeply woven into the fabric of supply chains and labor costs globally. Central banks are grasping for control, deploying experimental monetary policies that are fundamentally eroding the purchasing power of every major fiat currency simultaneously. Yet, amidst this historical unprecedented chaos, silver remains deliberately and artificially suppressed. For decades, the dominant narrative has been that silver is merely gold's volatile, lower-cost cousin, primarily serving as a speculative asset with minor industrial utility. But that narrative is a colossal, damaging lie, perpetuated intentionally by paper markets that have aggressively shorted the physical reality of essential industrial demand out of existence. The core conflict driving Eric Sprott's urgency is devastatingly simple but profoundly impactful. There is a tremendous, widening, and accelerating disconnect between the trillions of dollars in paper claims being traded on exchanges and the actual available, verifiable physical metal. For every single ounce of physical silver that is mined, consumed industrially, or stored by sovereign wealth funds or legitimate investment trusts, there are multiples of derivative contracts, futures, options, unallocated accounts, promising delivery. This is a highly dangerous game of financial musical chairs where the music is about to stop abruptly and there are nowhere near enough chairs, or in this case, nowhere near enough ounces, for everyone holding a ticket. The manipulators have been able to sustain this illusion of abundant supply because they have relied heavily on inventory cycling, the recycling of above-ground scrap, and the general ignorance and complacency of the retail investor community. But that inventory is not only dwindling, it is being aggressively drawn down by entities that understand the severity of the impending deficit. What specific empirical data points validate Sprott's incredibly urgent claim? What happens precisely when inelastic industrial demand, especially the colossal requirements generated by the accelerating green revolution and mandatory global solar energy buildouts, collides head-on with rapidly depleting, century-old above-ground stockpiles? And critically, what specific global monetary event is poised to act as the final, irreversible trigger that initiates the parabolic price move, shattering the decades-long paper ceiling and causing instantaneous price discovery based on physical scarcity? We need to understand the mechanics of this supply squeeze intimately, because ignorance in this moment will lead to irreversible financial displacement. Let's immediately unpack the supply narrative, which is the foundational bedrock of this final warning. Unlike gold, which is primarily held as a store of value and is substantially reusable, silver is structurally and perpetually consumed. It is not endlessly reusable in all industrial applications, often being degraded or permanently dispersed during processes like electronics manufacturing or chemical catalysis. Approximately 50 to 60% of all mined silver production goes directly into intensive industrial use. This includes high-tech electronics, critical medical devices, and, overwhelmingly, photovoltaic cells and infrastructure projects related to electrification. If you believe, as any rational observer of global policy must, that the worldwide shift towards renewable energy is an unstoppable, multi-decade macroeconomic trend, fueled by trillions upon trillions in mandated government stimulus, subsidies, and private capital expenditure, then you must accept that the demand for silver in this sector is fundamentally inelastic and exponentially growing. The sheer volume required for the global solar build-out alone, factoring in national commitments from the US, China, Europe, and India, is sufficient to overwhelm and dwarf current annual global mining supply within the next few short years. This is a mathematical certainty, not a speculation. And speaking of volume, if you are finding this granular level of detailed, fact-based analysis valuable and necessary for understanding the severity of this impending breakout, please make sure you hit that like button right now and subscribe to the channel. Supporting independent, thorough financial education is absolutely crucial in this market environment where mainstream narratives actively obscure physical reality. Your engagement helps us bring this vital data to a wider audience before the window truly slams shut. Furthermore, we haven't seen meaningful discoveries or development of primary silver deposits, mines where silver is the main target, in over a decade. Most silver production today is what the industry calls a byproduct. It is extracted incidentally while mining significantly larger deposits of base metals like copper, zinc, or even gold. During periods when commodity prices were generally depressed, which characterized much of the last decade, many primary silver miners cut back drastically on exploration and capital development budgets because it simply wasn't profitable. This creates an enormous, dangerous, and predictable supply-response lag. Even if the paper price of silver were to triple overnight, it takes a minimum of 5 to 7 years of sustained capital investment, permitting and construction to bring a brand new major mine into full commercial production. We are therefore facing a structural, unavoidable physical deficit that is mathematically guaranteed to persist and likely worsen dramatically for the entirety of this decade. This is why Eric Sprott's warning carries such weight. When Eric Sprott issues his warning, he is not speaking hypothetically about deficits a decade away based on abstract projections. He is looking at the immediate physical drain on inventory warehouses right now. He is watching COMEX and London Bullion Market Association inventories plummet to multi-year, or in some cases near historical lows. He is closely monitoring the increasing number of delivery failures and the increasing difficulty large financial institutions have in sourcing large investment-grade bars for immediate physical transfer. This isn't just abstract economic theory debated in ivory towers. This is boots on the ground, logistical stress screaming that the physical foundation of the commodity pricing system is fundamentally broken. The great revelation that we must grasp immediately, the core catalyst that will transform a persistent structural deficit into a parabolic, uncontrollable price breakout, is the fundamental shift in perception. For years, the vast majority of investors have held silver primarily, and correctly, as an inflation hedge, a tangible asset to defend against generalized price increases. But the true generation-defining multi-thousand% move, the one that will define this generation's wealth transfer, occurs when silver is recognized and valued not merely as an inflation hedge, but as irreplaceable essential industrial money. In a global monetary system rapidly losing all faith and credibility in unbacked fiat currencies, the final breakout trigger won't be a minor CPI inflation report or a slight change in Federal Reserve tapering policy. It will be a major coordinated central bank announcement, or perhaps the launch of a new, poorly structured central bank digital currency framework that signals the absolute, irrevocable, and panicked commitment to currency debasement as a permanent systemic policy. When the world's large institutional and smart money finally recognizes that holding trillions of dollars in unbacked liabilities and counterparty risk is fundamentally and exponentially riskier than holding a globally essential, finite physical commodity that is simultaneously required for the world's energy transition, the rush to acquire physical metal will be catastrophic and unprecedented. We are not talking about a modest move that simply doubles the price. We are talking about a multi-thousand% price realignment because there is simply no physical supply left available to meet the sudden, speculative, industrial, and monetary demand simultaneously. The evidence is overwhelming. Eric Sprott's final warning is rooted in irrefutable logistical failure, unavoidable industrial necessity, and terminal monetary policy suicide enacted by global central authorities. The time for deliberation, for waiting on the sidelines, for cautious hedging, is definitively over. The time for decisive, aggressive action, for understanding the mechanics of physical metal acquisition and storage, is unequivocally now. If you believe that understanding this imminent physical squeeze is vital for protecting and exponentially growing your financial future, then I urge you to share this specific analysis immediately with 3 people who need to hear it and act upon it. Don't just save the video, save the data. Study the inventory levels we discussed. And most importantly, stay tuned immediately for the second part of this critical warning, where we will transition from defining the crisis to outlining the precise, actionable strategies for deployment and the specific hidden risks you must actively avoid to fully capitalize on this impending and irreversible silver breakout. Ensure you hit the notification bell so you don't miss that crucial follow-up strategy session. The fundamental imbalance we are witnessing is not merely cyclical, it is structural, manufactured over decades by financial intermediaries who benefited immensely from suppressing the true price of the world's most critical industrial metal. We have crossed the event horizon of physical scarcity. We are now standing on the precipice of a monetary phenomenon driven by forced price discovery, a scenario where physics trumps finance, and physical reality absolutely overrules paper promises. When I speak about my final warning, I am not being hyperbolic for dramatic effect. I am referring to the mathematical certainty that the fractional reserve system built upon silver is about to implode. We are talking about a market where the paper claims far exceed the deliverable metal by a factor that would be laughable if the consequences weren't so dire for global stability. Think about the leverage involved. For every ounce of physical silver that sits in an accessible vault, there are hundreds of ounces, perhaps even approaching 1,000 ounces, traded electronically or via derivative contracts. This gigantic pyramid scheme is stable only so long as no one or no collective entity tries to take delivery in scale. But that is precisely what is happening now. The investment community is waking up, slowly but surely, realizing that the discount offered on silver relative to gold is an absurdity in a world desperate for electrification, solar capacity, and advanced medical applications. The industrial demand for silver, unlike gold, is non-discretionary and, crucially, non-recyclable in many of its highest growth applications. Once silver is embedded in a solar panel, an electric vehicle battery, or a complex circuit board, it is economically lost to the market for decades. This relentless consuming drain means the supply picture only gets darker, creating a demand floor that ensures any price dip is immediately met by buying, not just from investors, but from massive corporate entities who must secure their supply chain future. This tension between essential industrial necessity and managed financial scarcity is the primary conflict that must resolve itself violently. The bullion banks and clearinghouses, the institutions that have benefited most from this suppression, are effectively caught in a gigantic, self-inflicted short squeeze. They are short the physical metal they promise to deliver, and they rely entirely on the belief that the vast majority of paper holders will never, ever ask for the real asset. The moment this paper price attempts to move meaningfully past its current suppressed range, say, hitting the $35 mark and holding it, we enter the danger zone for these paper manipulators. $35 is not the target. It is merely the psychological trigger point where sophisticated institutional investors begin to question the liquidity and solvency of the entire COMEX system. At that point, the margin requirements for those holding the short position skyrocket. Imagine the cascade. These shorts are not small hedge funds. These are multi-trillion-dollar banks. When their margins are called aggressively, they face a terrible choice. Either cover their short positions by buying what little physical metal is left, or attempt to manage a price spike by selling more paper contracts, which only exacerbates the physical-to-paper ratio problem and adds gasoline to the fire. They cannot win. The physical market has already locked up the available supply. If you are following this progression of systemic risk and understand the gravity of the failure of delivery that is mathematically guaranteed to occur, then I urge you to take a moment right now. If you find this analysis critical and deserving of wider attention, please hit that like button. It helps this warning reach more people before the gates to protection close completely. The pattern interruption we are awaiting is the moment of definitive price discovery. It will not be an orderly march upwards. It will be a vertical jump, a spike that leaves observers breathless. People often ask me, Eric, what is the target price for silver? To answer that question, we must look not at silver in isolation, but at its historically accurate relationship with gold. For centuries, the average ratio of gold to silver was roughly 15-1 or 20-1, reflecting their rarity in the Earth's crust. For decades, the manipulative forces have pushed that ratio into the 80-1 or even 90-1 range, making silver absurdly cheap. If we assume conservatively that gold continues its climb, and I fully expect gold to easily breach $3,000 an ounce in the near term, given global central bank monetization and debt levels, then we must calculate silver's true value based on a normalized ratio. If gold sits at, say, $2,400, and the gold-silver ratio corrects to 20-1, silver instantly becomes $120 per ounce. If gold hits $3,000, and the ratio truly snaps back to 15-1 due to the industrial demand panic, you are looking at $200 per ounce. That is the necessary price movement required to bring supply back into balance with demand, to incentivize massive high-cost mining projects, and to finally ration industrial usage globally. This is not fantasy. This is the consequence of a supply-demand curve violently attempting to normalize after years of suppression. This breakout, which I believe is imminent, measurable in months, not years, will be triggered by the simplest and most brutal of market mechanisms, the inability of the clearing system to fulfill its obligations. When a major industrial player or an aggressive institution demands delivery of a large tranche of physical silver and the vaults are unable to provide it, the system will effectively default. We will see what amounts to a force majeure event in the metal markets. Once that happens, the price of paper silver becomes irrelevant. The true price will be dictated by the desperate scramble for physical ounces. This is why I stress that the only silver that matters is the silver you can hold in your hand, the silver outside of the banking system, outside of the centralized custody structures. Everything else is a counterparty risk waiting to vaporize. The opportunity here is not just about making money. It is about preserving purchasing power in a world where central banks are committed to currency debasement. Silver, particularly at its current valuation, offers an asymmetrical trade. A small investment today has the potential to realize triple-digit or even quadruple-digit percentage gains as the price is dragged kicking and screaming back to its historical and industrial fair value. This is the re-engagement point. Listen closely. I have been involved in the precious metals market for decades, and I have never seen the convergence of factors, scarcity, debt explosion, geopolitical instability, and industrial demand, so perfectly aligned for a catastrophic upside move in silver. This is not a drill. This is the moment to stop analyzing and start acting decisively. The climax of this narrative is not a theory. It is accounting reality. The financial giants who have been short silver for profit are trapped in a position they cannot escape without incurring losses that could destabilize their entire balance sheets. Their only hope has been to kick the can down the road, to manage the perception of supply. But the reality is now breaking through that carefully managed facade, driven by unstoppable industrial consumption. When the price moves, it will move so quickly that those who waited for confirmation will be left behind, unable to acquire physical metal at any reasonable price. The retail suppliers will simply run out of stock, just as they did during brief price spikes in the past, but this time the restocking will be physically impossible because the upstream supply simply isn't there. Therefore, my conclusive warning is simple, definitive, and urgent. Stop focusing on the daily price gyrations. They are noise designed to distract you. Focus instead on the relentless draining of the available physical supply. The breakout is inevitable. The failure of the system to deliver is certain. The price shock will be historic. Your preparation must reflect this understanding. Do not rely on paper promises or unallocated accounts. Secure physical silver today while it is still available at a massive historical discount. Do not try to time the market perfectly. Securing the asset is far more important than optimizing the entry price by a few dollars. The window of opportunity for acquiring meaningful amounts of physical silver before the fundamental shift occurs is rapidly closing. Do not miss the next stage of this crisis, where the focus will pivot from scarcity to sheer monetary chaos. Ensure you are subscribed to the channel now and hit the notification bell so you receive immediate updates when the market structure finally fractures. Educate yourself, prepare your portfolio for true price discovery, and secure your financial future against the final failure of the paper silver market. Time is no longer on your side. Act decisively and act now.